Hi there and welcome to another in our short topic videos on financial economics. This one focuses on the limits to credit creation by commercial banks. In the period 2010 through to 2013, the scale of new loans and overdrafts created by the leading high street banks such as Virgin Money and RBS and HSBC and Santander was actually negative. The loan books were shrinking. The annual growth rate shown in this chart was negative. Banks were sometimes calling in loans and the amount of lending they were prepared to do was falling. This reflected by and large a low demand for credit within the economy. It's only in the last couple of years that the supply of new loans and overdrafts, the growth rate of that has increased into positive territory again, 6.4% in the year to June 2016. I think the key point to make is that the main limit to money creation by banks is actually the demand for loans that comes from both households and businesses. In a modern banking, modern financial system, banks create money by extending loans to individuals and businesses. So the supply of lending in this country is essentially driven by the demand for loans. So therefore market forces play a key role. I've put here the scale of profitable lending opportunities. And by that I mean that banks take a commercially sensitive view about the risk factor when they lend to people and businesses. And if they think there is a profitable loan to be made, for example a mortgage or a loan to an expanding business, then they may well make that loan and create new credit in the process. But if the economy goes into a downspin or a slowdown, there may well be fewer profitable lending opportunities, or banks may take a decision that the credit risk, people who are unable to turn out to be able to repay their loans, the credit risk is too high, and therefore the scale of lending is cut. Second key factor that can limit money creation are the regulatory policies. We'll take an example of two in a minute: liquidity ratios and capital ratios. So banks may be required to maintain a higher level of capital reserve, which can restrict their ability to lend out. Crucially, in a modern economy such as the UK, the growth of money creation by commercial banks is actually driven by the decisions that we take as consumers and businesses. First of all, about how much debt we're prepared to take on board, and secondly, how much debt we choose to repay. And the fourth factor, which fundamentally influences the demand for credit, which then affects the supply of credit, must be the price. So the monetary policy decisions of the Bank of England affecting base interest rates and then filtering through to interest rates for savings and loans throughout the system will clearly affect, at the margins, the demand for lending in the economy. So interest rates do affect demand for loans, and the demand for loans then affects the supply of loans in the banking system. Quite interesting if you look at this chart, follow the base rate in the UK has been very low for many years, of course, but follow the costs of typical unsecured lending. A £5,000 loan, £10,000 loan. The cost of those loans have come down in recent times, but they still actually remain relatively high compared to the base rate. So typically a £5,000 personal loan is going to cost you nearly 8%. A £10,000 personal loan may cost you less, may be secured on assets. Bank overdrafts are expensive, typically very expensive if they're unsecured. And of course, credit card lending remains also very expensive. So interest rates on consumer loans in the UK, sourced here from the Bank of England, have come down in some cases in recent years, but they remain very high relative to the base rate of interest. And that's a constraint on lending. I've said before that there could be some intervention in the banking sector which can affect the ability of banks to inject fresh lending into their business. And we need to make a distinction between a liquidity ratio and a capital reserve ratio. So a liquidity ratio is defined as the ratio of the liquid assets held by a bank on their balance sheet to the value of their overall assets. Banks typically do need to hold day-to-day enough liquid cash to cover the demand for cash from depositors. And post-global financial crisis, including the Basel Agreement, that required the leading commercial banks to keep enough liquid assets, including cash, to get through a 30-day financial market crisis. So liquidity ratio means that a bank has to hold a higher level of cash and other liquid assets to their deposits, to their other assets, and therefore it means that there may be a limit to the amount of lending that a bank is able to do. There may be a limit. A capital ratio is a similar theme. It's another form of regulatory intervention. A commercial bank's capital ratio is the funds the bank has in reserve matched against the riskier assets that it holds, including some of the riskier loans. And the European Union now run a regular stress test to see whether the commercial banks have sufficient capital as a buffer to weather and absorb losses from very difficult economic financial conditions. So the central banks run so-called disaster scenarios, for example, a 30% fall in house prices or 5% fall in real output in a recession, and consider whether commercial banks can withstand the losses on their loans in those kind of disaster scenarios. Now, banks need to maintain sufficient capital. That can involve selling some extra equity to investors or ploughing back some of the profits they've made from their lending into a capital buffer stock. When the capital ratios are particularly high, again, that can in theory constrain how much banks lend out. In practice, day to day, the capital ratios do not fundamentally determine the amount of credit they can lend out, because the amount of credit that banks lend out is determined by the demand for loans. Here's an example of the capital ratio for Lloyds Bank, one of Britain's biggest banking groups. And you can see that over the last 5 or 6 years, Lloyds has increased its Tier 1 common capital ratio. It's increased its capital buffer stock so that it's better placed to weather difficult times ahead. This chart shows the annual growth of lending to UK individuals from the banking system. And it reinforces what we saw a few minutes ago, that during 2009 into recession, into the early years of the current decade, total lending, it's not just loans and overdrafts, but total lending was pretty flat. It's now starting to pick up again. So banks are now accelerating the rate of change of credit created by the system. The key point is that the main limit to credit creation in the modern banking system is not the amount of savings that banks have in their accounts which they can lend out. The main limit to credit creation is the demand for credit, which comes from individuals and businesses. And we think the main limit on credit creation in that sense must be the price, the interest rate.